Well, good afternoon, everyone, and thank you for joining the MIGO Opportunities Update webinar at what is a particularly interesting time for the strategy. You might have read this morning that the board have appointed AVI to become the company's investment manager, and they are expected to commence in Q4 of this year. Until that point, Premier Miton remain the investment manager, and Nick remains at Premier Miton to manage the portfolio. Nick, of course, resigned from Premier Miton, and his affairs after he leaves are a matter for him, but it's pleasing that AVI have hired Charlotte Cuthbertson, former co-portfolio manager of the trust, to manage it when it moves over in Q4. And AVI have also informed the board that it expects to be able to announce a further senior level appointment to work alongside Charlotte in the coming months. Now, onto the exciting stuff. MIGO is, of course, seeking to exploit mispricing opportunities in the closed-end fund world, buying discounted investment trusts where, importantly, there is a catalyst for that discount to narrow. And to provide some context, what you can see on screen is a long-term average discount chart for the investment trust sector dating back to 1990. And what is striking is that outside of the global financial crisis, we are touching record levels. Why is this important? Well, historically, MIGO has generated its best returns when the average underlying discounts on portfolio holdings are at their widest. The reason being, if you identify an out-of-favor asset class in an open-ended structure and sentiment changes, your return is capped at the NAV return. However, if you identify the same out-of-favor asset class held within a closed-end structure and trading at a discount, you have the potential for a powerful combination of a rising NAV and a narrowing discount. And Nick has a chart, an illustrative chart on this later on to put some numbers to it. But outside of the theoretical, you only have to look at MIGO's performance history to prove this. 2016 saw discounts widen due to the Brexit referendum, and in the following year, MIGO generated share price returns of 32%. Again, in 2020, when discounts widened due to the COVID pandemic, the following year saw MIGO return 25%. And then in 2008, when discounts became extreme, MIGO generated 45% the following year. Now, we often educate shareholders that an investment in MIGO can be periods of watching paint dry, intertwined with explosive runs, the likes of which I just mentioned. And given discounts are so extreme at the moment, it's likely that the seeds for that next run are in the current portfolio. So with that, I will hand over to Nick.
Thanks, Will. And just to make the point, in the areas that we fish, the often overlooked, the width of the discounts has become more extreme. So the chart on the screen at the moment is really more the larger trusts, which are equally on wide discounts. The original intention of this update was really a quick ad hoc call, just to maybe quite short and sweet, just to run through some of the developments we've had in the last month, because there's been a lot of activity and a lot of volatility in the trust world, and we has actually faced perfect storm, which has led to sort of rapidly widening discounts. MIGO largely dodged the bullets because we weren't in the highly rated areas that have derated, and we had a lot of cash going into it. That money's being spent, and we've gone from a peak of 22% to 12%. And there's a lot of things. There's three situations which we're buying into at the moment. But with that, I mean, just looking at the perfect storm, and there were five things that were going on, which caused the dam to burst. I think it was the 26th of June, when we had some fairly dramatic falls in widespread right way across the trust sector. One was rising rate expectations. Also, we got anecdotal mentions from two or three brokers that there were some US investors shorting the FTSE 250. Now, but they were shorting the pure version of the 250 rather than the ones we tend to use in the UK, which would be the 250X investment trusts. So if you do that, and there are 30 trusts in the FTSE 250 on a look-through basis, you're even shorting the likes of Vietnam Opportunities as a play on the declining UK. So that would explain why the larger trusts took a bit of a dive during that period as well. We've got the ongoing consolidation of the wealth management industry, which makes many trusts less attractive because the pots of money are becoming so large. We've got the OCF, the calculations of certain areas that that trusts appear, particularly in alternatives and private equity, to have quite high expenses, which have to be declared by some investors, when they're disclosing on their own products. And we've also got the fact that basically 6 or 7 stocks in the US have driven most of the rise in the indices, which means that right across the space, a lot of wealth managers are nowhere near their benchmarks and beginning to get pressure from their customer base, and that's causing some investors to sell. They feel under pressure that they ought to be seen to be doing something. So we had 5 things there, all coinciding at once, which has triggered this rapid widening in discounts. And if you look at rising rate expectations, I think that's caused significant problems in the alternative space, because those alternative funds were largely created to solve yield starvation. There was a period for many years where deposit rates were effectively zero, and owning infrastructure trusts or alternatives or song rights or shipping was a good way to generate yield for clients. But even I've been buying short dated gilts PA for the first time in 4 decades. You're looking at a sort of a total return of around 5.2%, and if you can get that from conventional sources, why would you own, for example, Hickel yielding a 6%? And therefore, that it's taken a prop from underneath that sector. And as I said, the dam burst on I think it was the 26th of June when we saw widespread falls in the sector. I think what we're looking to do in this, our reaction to all of this is looking to arbitrage situations where there's a lack of demand for the product. There's a lack of demand for these high yielding trusts, because as I said, you're getting decent income from conventional sources, but the underlying assets are very much in demand. And we're buying a number of stocks at the moment, which we probably can't mention simply because we haven't completed our orders. But one where we have completed is Aquila, which is a European renewables fund, where the NAV is sort of an actuarial calculation, but if you were to value these, the underlying assets, the wind farms, the solar plants they've got, they're probably worth a lot more than NAV, because those assets remain in demand. And therefore, there is a chance here to arbitrage a trust that itself is unloved and unwanted and trades on a wide discount, but actually owns assets that are comfortably in demand, and that's basically what we're looking for. I mean, we've had a lot of expression of the death knell for trusts. I mean, I've heard this many times before. I mean, probably about 2 times a decade. I'm told that the investment trust industry is dying, and there are some challenges, but we're down to our last 182 billion, and very quickly, once we have this dislocation, the law of natural selection kicks in. I mean, the trust sector is very good at evolving and adapting to different conditions. And just off the top of my head, I mean, we've had, in corporate actions, we've had Industrials REIT, Civitas, Aberdeen Japan, Columbia Property, Henson Diversified Income, Shires, and the Investment Company, just to name a few of the ones that have got sort of corporate events. So, the sector is very good at evolving and developing. And there are plenty of self-help actions that can be taken. We've got oversupply in some areas. We had a massive new issue boom a couple of years ago, which has led to an oversupply of shares. So buybacks can help. Trusts that still want to be attractive to big wealth management chains might consider mergers, and we've got 2 or 3 of those going on at the moment. But also to target new audiences. The self-directed investor is still very keen on trusts, and also there's an increasing number of investment-led wealth managers that are launching new firms, often under the auspices of Raymond James, who can still actually advise their clients and not sort of customer liaison officers you can be in some of the very biggest chains. So there are new audiences. There are new buyers of trust that take on, and the audience has evolved over the years. If you look at the slide that I've put up, it'd be very difficult for a number of these asset classes to be structured anything other than a closed-ended fund. If you do want to be in second-hand life policies, or ground rents, or corporate mortgages, or shipping, or private equity in Georgia, it has to be a closed-ended fund, and therefore, I think we hopefully can ignore the death knell for the industry. Although recent events, there may well be the death knell for individual trusts, and I think we'll carry on losing plain vanilla equity funds unless they're doing something to use the capital structure, to use the investment structure to build conviction, or to use leverage, etc. Just turning to the portfolio briefly. There are given the size of the dislocation we have at the moment. There are 3 trusts that we're buying. I'm not going to name them because we're buying pretty well every share that becomes available. It's a slow old process because liquidity is particularly tough at the moment. But one of those is on a 41 discount, one's on a 36, and one's on a 61. The mechanism has just lost all touch with the fundamental value in the number of trusts that have sort of become unloved and overlooked. A couple of ones to mention. We continued adding to activism in Japan, and we bought JP Morgan India, which is sort of more conventional than our usual targets. One that's gone is Industrials REIT, which was taken over by Blackstone. And I think we'll carry on seeing the corporate developments being at either end of the quality spectrum. So Industrials REIT was a really good quality mixed like industrial portfolio, trading on an extreme discount. I think it was around 36 just before it got taken over. And the management just felt that rather than be an investment trust, they would be better served developing the portfolio and looking after the portfolio within Blackstone. But Blackstone are not known for overpaying, but they pay a 3% premium. And therefore, the offer of 168 compared very favourably against the 118p that we were valuing our holding at the night before. As I said, we've been spending money. Our cash position peaked a few months ago at 22% when we had a big tender from Dunedin Enterprise, and we're down to 12. But we're trying to spend that money as fast as we can at the moment. So the direction of travel is very much to the buy side. JP Morgan India. We're sort of long-term bulls. It's quite an expensive market, but it's a classic situation where the trust will trade on the track record of the vehicle for some time after a new management team has been appointed. And we had a change some months ago where a new team has come in that can target a few more small and medium-sized companies and can build a bit more conviction into the portfolio. The special situation element here on JP Morgan India is that they have windows of performance, and over a period of that performance window, if they underperform the index, then they give 25% of the holding back to investors at around NAV. And there was a chance a few months ago to buy this at a 20-21% discount, and they are so far behind the latest performance window that they'll have to perform like a train to not hand back 25% at NAV in about 18 months' time. So in effect, but when you add that back in, it was buying an improving fund on a discount of around 25%. The activism in Japan, which is relatively new. Basically, sometimes in life, experience is an impediment, and I've been told so many times that this time is different for Japan. That when these trusts were launched, I rather ignored them. But I think this time is different in Japan. When you're talking about domestic Japan, the international companies have had to evolve because they've had the commercial pressures of the international market. But if you look at domestic stocks, half of them trade below book. 700 of them are trade below half of book. And when you bear in mind that 40% on average, 40% of the book is actually cash, it is a sort of discount on a discount. The implied discounts are higher. Tokyo Stock Exchange has come up with some new rules that if you're trading below book, then you have to explain yourself. Naming and shaming works in Japan. But the change is that if there's a pragmatic approach, very often you'll get a hearing. There's a generational change where some of the younger generation perhaps don't want to run a metal bashers in Kyoto. They'd rather be a corporate financier in Tokyo, and therefore this generational change has to be managed. And in many cases, managements of companies are quite happy to listen. I think if it's an asset stripping exercise, you'll still get rebuffed, but there's definitely a change. Takeover bids in Japan have doubled in the last few years. Buybacks are at record levels. So a couple of new things in the portfolio, but there's three other situations that we are buying as aggressively as we can, and all very much in the special situations camp. And as I said, 41 discount, 36 discount, 61 discount. On the 61 discount, we think the NAV is rising, not falling. So, but interestingly, that certainly in two of the cases, there's a very clear catalyst for the discount to narrow. It's interesting times. The widening of discounts means that MIGO's NAV is up a little bit year to date, but basically, the average share price is massively underperforming the underlying portfolio. We look at the winners: Georgia Capital, MIGO Air 4, and of course the Industrials REIT, or the result of a takeover bid. Georgia Cap is trading on over a 60% discount. I think the MIGO is probably trading on something similar. I'd like to ask some questions about the ins and outs of those two. Disappointment so far this year: Phoenix Spree passing its dividend. I think they underestimated that when you're presenting to the UK market, passing a dividend is a sign of distress. So I think management were fairly shocked and surprised that when they were making an announcement, they thought there was no new information. The shares managed to fall 40p on the back of that. I suspect that the shareholders are fairly united on that one, and it may well be a corporate action may develop there in the coming months. The other two disappointments, Baker Steel and Geiger Counter, I think there's a lack of interest in developing of mines at the moment, and there's very little money around for it, and therefore it's difficult for Baker Steel to develop any of their projects, which is understandable in these conditions. But Geiger Counter is a bit of a surprise because it simply owns uranium mines and uranium mine developers. Uranium price has been quite strong, so it just feels though it's got caught up within the lack of interest in small mine and junior mining stocks. Short and sweet. Looking at the outlook, I think probably a couple of slides would sum it up. There's the top 12. As you can see, the average discount 31.3. The latest presentation pack is in production, and that's the average discount is slightly higher, but it probably went to about 34 during the sharp sell-off. This slide typically would have a discount of between 15 and 20%, and it's been drifting up quite sharply in recent months, and it's just gone straight through the 30 mark with barely a pause for breath. But as Will was making the point earlier on, the seeds of the next bull run or the next explosive run come when you get discounts this wide. And the next slide just sums up the holy grail of what we're looking for. And this tends to be what happens when trust will move from being on a deep discount to trading around par. And this is modelled on Ecothin a few years ago, which is a stock that we had. But the important point on this slide is that the dark blue line and the light blue line are the same underlying portfolio. One is NAV and one is share price. So if you spotted, and this was an infrastructure portfolio, if you spotted at the time that the sector was out of favour, you backed the sector and you proved right, you'd have made over 40% of your money, which is great. But if you bought it as a bombed out investment trust trading on a discount of over 30%, where the discount disappeared altogether, you more than doubled your money. And that's the seed of where you look at the explosive performance that MIGO has had in 3 or 4 phases in past life. This is what's going on, and this is the engine of what's happened. But it always has to start with trust being on very wide discounts in the first place. And at the moment, there are multiple opportunities to buy trusts. Well, much wider. That 30% figure is an average. So you can see that there are perfectly decent funds around there that trade much wider than that. I think we're going to look back at the summer of 2023 as the moment of an opportunity. But obviously, when you see these crunching falls, people become fearful and are too nervous to buy. Although, what we're finding with some of these wide prices or wide discounts is that the market has marked these aggressively down to dissuade sellers to avoid taking stock onto the book. But they don't really want you to sell you any shares either. So on the things we're buying at the moment, it might take 40 or 50 trades to actually build a position that moves the needle. But as I said, I think we'll probably look back at the summer of 2023 as one of those moments when there was fantastic opportunities around. And actually, you're looking at the landscape. If MIGO didn't exist, somebody would probably invent it, because we look for the unloved and overlooked, but there are vast tracts of unloved and overlooked at the moment. So, but anyway, that was a short and sweet run around the houses. But I'll pass you back to Will to see if there are any questions.
Thanks, Nick, and just remind everyone that you can ask questions using the Q&A function at the bottom of your screen. Perhaps just to start with, you mentioned the lack of demand for the investment trust structure. Are we seeing the real world come and take the assets yet? Has that started?
Beginning to see it, but it takes a while. And when I was saying the lack of demand for the investment trust structure, I was probably really thinking about the high yield structure, which is where there's been a lot of supply issued and demand has dried up simply because there are now alternatives. I think that the reaction, you will see some corporate events, but of course the dam bursting was only about a month ago, and therefore these things do take time. So yeah, I mean, if these, I mean, that's the point. If these discounts persist, and perfectly good assets are trading at 60, 70 pence in the pound, then the real world will come and take them. But it might involve a little bit of, as you say, watching paint dry first before we get there. But certainly it's unlikely that discounts can widen further without triggering even more corporate activity.
How do you challenge the consolidation of the wealth managers to retain their investment trust investments, or does this provide the catalyst to the narrowing of discounts or wind up of smaller trusts?
Well, I think that if you look at the Rathbones Investec merger, and that will bring in 100 billion. The direction of travel is more standardised portfolios, and if you've got 100 billion pot, I mean, we're not there yet, and won't be there for years. But if you have a 100 billion pound pot, and you think that you need 1% to move the needle in a portfolio, then you need a £1 billion ticket. So even if you're buying Scottish mortgage, that's an issue. So I think that it's slowly but surely they will reduce their trust exposure, and therefore that does will create challenges for the investment trust world. Some trusts will merge to get bigger if they still think that's an area they want to target. But it'll usher in a period of evolution, which we've had many times before. I mean, when MIGO started, most of the shareholders were institutions, the M&G or F&C and some of the Scottish institutions. Then, as they moved on, the private client stockbrokers took over, and they were the natural buyers. Now they're being consolidated to become a bit large for the trust market. It's the self-directed investor, retired company director who reads that MIGO is as gracious thing sliced bread in Money Week, buys 20 grand's worth on his Hargreaves Lansdown SIPP on the Monday. They will be a natural holder. Also, what's interesting is that a vast number, probably the most common buyers of MIGO, for example, are people who have founded new businesses leaving the big chains. And I think that the rapid consolidation will speed that up, that people may not want to work in a big chain normally running, say, 500 million. They might prefer to be running 200 million in a barn conversion somewhere, but actually able to look after clients. And there's a big growth in that type of advisor. So whilst we'll be losing shareholders, or the industry will be losing shareholders from big chains, the new sort of independents that are very often under the auspices of Raymond James, will take on some of the, will replace some of the shares that are being lost on big chains.
Thank you, Nick. Do you mind just popping the portfolio slide up, or the average underlying just might prompt?
That one?
Yeah, thank you. What area are you most excited about?
What area am I most excited about? I'm not sure there's the interesting thing is that the opportunities that we're buying into are all so different. But I suspect the area doing most work on at the moment are some of the sort of renewables and the infrastructure areas. Partly because we don't know it so well, because they trade on premiums for so many years that there wasn't a great payback. But it's just looking for these situations where trust has got caught up in the lack of demand for that kind of structure, but they've got really decent assets, and that's sort of work in progress. We've identified one. There's another one that's one of the 3 stocks that we're buying, but it will probably take 40, 50 trades to actually move the needle, and we've probably collected sort of half, 30%, 40% of what we're looking for. So because the damage has been done so far across the piece, that the opportunities are all very, very different, and there isn't one sector that I would pick out as getting me excited.
Thank you. Do you see any particular catalyst to restore discounts to normal levels?
Greater acceptance of risk. At the moment, people are actually quite nervous. I think when there's actual activity, corporate activity, getting involved, that it'll help people recognise that that there is value in these prices and validate prices. There will need to be some supply taken off, so we'll need to see buybacks across the range to get rid of the oversupply situation, or basically the self-help activities will trigger it, combined with a bit of risk on, which will happen again one day. At the moment, people are very, very cautious.
Thank you. Is your patience infinite? I'm not sure what that relates to.
Well, yes. I mean,
perhaps maybe in the context of waiting for these catalysts.
Yes. Do we wait forever? I mean, typically we envisage a situation for being probably around the horizon being probably a couple of years when you enter something, and that's because the fund managers tend to only look about 18 months in advance. Anything beyond that, because we're measured, analysed and measured almost on a daily basis, that if the payback and the catalyst is more than 2 years away, that's effectively never. But that means that stocks that sit into that area tend to be completely unloved, and therefore that gives you an opportunity to get in, because not many other fund managers will be interested in something that's probably 2 years over the horizon. So yeah, I mean, but sometimes we do lose patience with things, and we always normally are involved on a couple of corporate actions, and they tend to be salvage operations, to be honest. And once our patience has snapped, you do get involved in corporate activity, but that's not our natural style. We're not ARBs, but sometimes you do need to step in. So that's the answer. Envisage 2 years. I mean, there are certainly things in the portfolio that have been in there for 3 or 4 years. But yeah, if something has failed because the liquidity is quite tough, then the exit normally has to be a corporate activity.
Thank you. Why is Yellow Cake trading on a discount if it owns a theoretically fairly liquid asset? Should they not address this?
Very good question. They haven't done much in the way of buybacks. Mining, or junior mining, as I said, Geiger Counter has struggled. They've been quite aggressive, issuing on a regular basis. So you'll need to do. I mean, the discount has subsequently got much wider than that. At times has touched about 20%. So they will need to buy back some shares. The problem is, because it's effectively a bit like an ETF, you have to sell some uranium, which is not the most liquid of markets. But yeah, I mean, it's. I think we've expecting, quite bullish on price of uranium, and it's been ticking up quite nicely in recent weeks as the demand for nuclear power increases. And given that the uranium price has bombed out for so many years, as demand picks up, it will be difficult for the mines to supply it, simply because the time taken to develop a mine from scratch is probably 10 years. So uranium is not a rare mineral, but to actually increase the supply of it, there's a long lead time, and I think demand will pick up relative to the industry's ability to produce it. So it's really more a call, or top-down call, on the price of uranium, rather than this one being a special situation.
Thank you. That that's all the questions we've had in relation to the portfolio and sort of markets. There are a couple in relation to this morning's announcement, and I can see the names of those who've asked them, so I can get back to you on that. But I don't know if you had any closing remarks, Nick, or...
No, I mean, I think it's just great time to actually be building and putting some money to work in this area. I mean, MIGO is sort of a one-stop shop for getting exposure to this, because there's quite a lot of heavy lifting to actually get in and out of these positions. Yeah, I mean, if it's an ideal way of playing it, and of course, our own discount has drifted out wider than normal. I would guess that's because there's been uncertainty about future arrangements. Yeah, and also when these things start moving, MIGO tends to sort of move. It tends to be in the second or third wave. So sometimes you get to see the NAV begin to go up, as we've seen in recent days, but it takes a few days before the share price will follow suit. So probably, beginning to sound like a salesman, it's probably a useful window of opportunity to pick up some MIGO.
Sounds good.
To be salesy, I don't know. Suddenly found myself in that. Once I started thinking about it, I was getting even more bullish. Yeah,
no, sounds exciting. Well, thank you very much, Nick, and thank you everyone for joining. If you do have any follow-up questions, please email ir@frostrow.com and we will get back to you. Have a good afternoon.